purpose of this presentation, and it's actually a series of 3 meetings, which I'll mention later. The purpose of this is to give people who are just starting out and who are fairly new to investing, is to kind of go over some of the basics of investing in personal finance. So we're going to cover some simple investing strategies, compare different vehicles and account types, and talk a little bit about Canadian taxation while I try to keep you awake. So what we're looking for maybe is to become financially independent and saving for retirement. So what I would like you to walk away with after the 3 hours, which I'm thinking the 3 sessions will take, is number 1, how to begin investing, knowing the basics, and be motivated to start investing, to educate yourself further by becoming interested, or at least see the importance of investing. After 2-3 hours, we're not going to make you ready for Wall Street. We're not going to make you ready to be an expert. But what I would like is for you to say, okay, this is important, even if it's not the most exciting thing in the world, and I get it. And so I need to do something. And the sooner you start investing, and the sooner you educate yourself, the better, and your future self will thank you. So that's kind of my purpose here. If you have any questions during the meeting, feel free to unmute yourself and ask. I don't know if this is my first time running one of these, so I can't, I don't know where the chat notes are or anything like that. So just unmute yourself and just ask, interrupt me. So over here on the left, you can kind of see the itinerary more or less. We're going to get about halfway through it. And we'll save the rest for Thursday. This is going to be fairly.
May I ask a quick question?
Sure.
I noticed that you're recording. Will this recording be available after the seminar?
Yes, thank you. It should be up on the cloud. And if it automatically sends a link, great. If not, I'll get it and I'll try to send it to everybody.
Perfect.
I think. Perfect. I think a good number of people here are through the meetup.com, whether through the group that I created or I leveraged a couple of other folks, and thank you very much for advertising me on your meetups as well. So if you need to, just I'll tell you the meetup group, and you can sign up there as well. So yeah, if you have any questions, do stop me. Otherwise, I'm just going to go and just keep going. So I'm going to be presenting long-term investing approach. No day trading, no options, no get-rich-quick strategies. This is going to be where you let time and compound interest or compounding work for you. And again, it's going to be fairly junior. As if you know how to do mutual funds, if you know how to do exchange traded funds, maybe you'll pick something up. Maybe it'll be a little bit boring for you. So it's up to you. So about me, some caveats and just some notes. So I'm not a certified financial planner. I can't sell you anything. I don't intend to sell you anything, neither myself or any products or any services. But please note, and this is the big lawyer disclaimer, this is not investment advice. It's for educational, entertainment, and demonstration purposes only. And it's not a solicitation to buy or sell any securities. And please don't sue me. Please educate yourself, make up your own mind, and make your own decisions on anything that you do. This presentation is what I've done multiple times for coworkers. I've done lunch and learns because at work I talk to anybody who will listen about investing, and so I just kind of put this together, and I kind of keep working on it. So I've been an investor for over 20 years. Started out with mutual funds, got into stocks, real estate, and private equities, which I'll mention later. My personal approach is I'm fairly risk friendly, and my overall, and I'm not advocating, I'm just saying this is what I do, is I like emerging markets in the long run. Now I do have a couple of sponsors who footed the bill for the Zoom and the meetup. One is Oak Avenue Neighborhood Society, and the other one is the Vancouver Foundation's Neighborhood Small Grant. And so if you have a project that benefits the community, such as I hope this one does, then you can see them, and they might throw some money at you. Okay. So today is the first of the meetings, and the next one is Thursday, and then that's part 2. It's not a repeat of today. And then Monday is in a week is kind of the question and tidy up kind of a session. I was only planning to do these 3. If I get 20 people in a week asking lots of questions, I'll do more. But I was sort of just going to do these 3. I do have other presentations, but they're more advanced. So if there's an etc., that would be great. And so here's on meetup.com, it's Investing Basics Meetup. If you don't have a link to these 3 guys, then go over here, sign up, and you can get the link. Any questions before I kind of launch into this? Everybody sort of clear? Everybody think they're in the right place? You know, this is English 101 in your first semester of investing. Okay, all right. I'll try to pause every so often, but feel free to interrupt me. So vehicle definitions. So I'll run through a list of word usage that we use in the investing world, just so we're all speaking the same language. So when we're talking about stocks, shares, or equity, the main thing is it's ownership in a company, and it may pay dividends from the profits the company makes. You're an owner. Bonds are loans to either government or to companies, and they pay interest. Okay, so that's the key difference. Stocks is ownership, bonds is loans. You'd be shocked how many people don't know even that basic thing. Asset allocation, it's a long phrase for how you divide up the investment money between stocks, bonds, and other assets, as well as what types of stocks. Are you investing into big companies, or are you investing into small companies? So if I say asset allocation, it just means how am I distributing the money. An index is a representation of a stock exchange. So you'll hear S&P 500, so that's 500 companies on the New York Stock Exchange, or if I say TSX, it means the Toronto Stock Exchange. So if the TV or newspaper says TSX was down today, they're talking about the index. It just represents the exchange. They just add up all the companies, they divide them by a big number, and if that index goes up, then more companies went up that day than down. And it's used as a benchmark for other vehicles. And also, if I talk about the market, you can assume that I'm talking about one of the indexes. Then we have actively managed and passively managed. So if we're talking about an investment or a bucket of investments, if it's actively managed, it means there's a human making the decisions. If it's passively managed, then it's following some sort of a formula. So it's either following an index, it's following a given sector, such as, you know, an energy sector, or there's some kind of a formula. The company has to be at least this big. It must have had profit in the last 2 quarters, and so on. These next three are describing the stock market. So correction is if the stock market is down 10% from a recent top. I'm sure you've heard these terms. Bear market is something that's down trending, and it's down 20% from a recent top. So up until fairly recently, we were in a bear market where the market dropped roughly 30%, depending on which index you're talking about, which market. It dropped about 30% from the February highs. Bull market is the opposite. It's the uptrending market. It's about 20% from a recent bottom. Okay. Recession and depression describe the economy. I had a question about that fairly recently, so I threw these in. So recession is when the gross domestic product, i.e. the economy, the total sum of goods and services produced in a given economy has decreased 2 quarters in a row. You're generally expecting the economy to be increasing. And if it goes down 2 quarters in a row, it's called a recession by definition. A depression is when it depends on who you talk to, but basically it's a long-term recession lasting more than 2 years, or if the GDP's decreased more than 10% from the top. The last one was in the 1930s, not a pleasant experience for anybody to go through. Okay, I'm gonna pause for breath here. All of that is fairly clear. I'm assuming most people knew at least or heard of these terms. So I'm gonna keep going. Again, do interrupt me. A brokerage is a place usually online where you can buy and sell stocks, bonds, and other assets. Capitalization is the worth of a company. So you take the price per share and you multiply it by the number of shares. If it's under 100 million, then it's micro, all the way through to giant, which is 20 billion plus. You'll get different versions of these ranges. I think there's like 3 companies or 4 companies in the world which are over $1 trillion. I want to say Microsoft, Amazon, maybe Google, and I thought the Saudi Aramco also was over $1 trillion, but I could be wrong about that. Management expense ratio, here for always to be called MER. It's the percentage of assets the owner pays when you own a mutual fund or an exchange traded fund to the company that runs that mutual fund or ETF. You never see it go. The company just sort of deducts it and it lowers the share price, but it definitely detracts from the performance. So be aware of the MER. Mutual fund is a basket of investments. It could be pretty much anything, including stocks, bonds, real estate, gold, and cash. And a balanced fund is something that includes stocks and bonds. Okay, so that was a quick introduction. These are kind of your basic terms. If you're investing, it would be good to kind of be aware of these. So now we're going to go into different vehicle types. So these are different things that you can buy, which you're hoping will either kick off money, as in dividends or interest, or will increase in price. Okay. So the most basic one is stocks. Again, shares in a company, its ownership. They usually have a ticker, or always have a ticker, and they're bought and sold on an exchange. The fees are, there's usually, and it depends on what brokerage you're using. So I would definitely suggest you do your research if you are going to be buying individual stocks, which for beginners I wouldn't recommend, but it's up to you. There's usually a commission to buy and to sell. Some brokerages won't charge you anything to buy, but will charge you to sell. Others won't charge you any commission at all. Most brokerages will charge you $6 to $10 per transaction. Some might charge you per share. It all depends. You got to figure out the rules and then pick the brokerage that will kind of service you the best for what you want to do. So if you have $1 million with them, maybe they'll charge you $6.95 instead of $9.95. I'm making that up. The pros of using stocks is there's no annual fees. Once you paid that commission, there's no additional fees. The cons are they're not really diversified, and on most Canadian brokerages, we're limited to US and Canadian stock exchanges. So to buy something in Europe, I am not able to do, for example. Maybe other brokerages can. Okay, so that's stocks. Then we have ETFs, exchange traded funds. So when you buy an ETF, you buy shares in a bucket of assets. It also has a ticker, also bought on a stock exchange. If they are passive, and most of them are, few of them are becoming actively managed, then they follow an index or a sector, or some sort of they follow a formula. So the passively managed ones follow a formula. Same kind of commissions to buy, but now you're also annually paying a MER, a fairly reasonable one compared to mutual funds, for example. The benefits are you get your diversification, the fees are low, and each brokerage tends to have a set of ETFs that you can buy without paying this $6 to $10 commission. Like my brokerage has about 100 ETFs. Problem was I didn't like any of them, so it didn't help. The downside is they're passively managed, and if they follow an index, they're not going to outperform it. So they're just going to follow, if it is an S&P 500 ETF that you bought, that's what it's going to follow, and it's always going to be this much below that index. Okay. So mutual funds, we're going to split it into two. The actively managed ones, you're buying shares in a bucket of assets. This is a technical thing, but they're bought and sold overnight, so you don't see the value of a mutual fund change during the day. They have some sort of a code. Usually looks like this. Depending on the mutual fund and the mutual fund company, the MER will be significantly higher than the ETFs that we had up here. And there'll be penalties for sale if you sell. It depends on how you bought that mutual fund, and I'll get into that probably on Thursday. There might be penalties for early sale. The benefits are you're getting diversification. So what I mean by diversification is that instead of buying a single stock, you have 50 stocks and maybe some bonds thrown in there. If I wanted that kind of diversification, buying individual stocks, I would have to make 50 individual purchases of stocks, and each one would charge me $10 commission. So I would have to make fairly large purchases. Like I wouldn't do a $100 purchase, because then the commission would be 10%, which would kind of suck. But with a mutual fund, so I wouldn't do that myself. I wouldn't diversify by buying 50 stocks individually, because it would cost me $500 in commissions. But by getting a mutual fund, you can start some of them as low as $100. Some of them have a minimum of $500. Some of them are $5,000. But you're able to get diversification with a single purchase and without paying so many commissions. You just make the one buy. And of course, diversification is beneficial because if one of those 50 companies goes bankrupt, you shrug your shoulders and it doesn't really do that much. But if you only have 5 stocks and one of them goes bankrupt, then you're scratching your head and reevaluating your life's decisions. With the actively managed mutual funds, you have a human making the decisions. Hopefully they're super intelligent and they deserve this fee that they charge. Not all mutual funds outperform their index. Actually, most don't over a while. And one of the reasons for that is this MER. Because the fund is always a little bit underneath its index. On a plus side, there's no commissions to buy and sell mutual funds. At most exchanges, I know there's one exchange which charges commissions to sell mutual funds or to buy and sell mutual funds, and then it doesn't for stock. So that one just works in reverse. So you have to know what you're going to want to buy, as I said before. The downsides are actively managed mutual funds have fairly high fees. I'm going to throw this out there. It's debatable, but the salesperson selling it to you has a bit of a conflict of interest in that they make commissions off of the sale. And as I said, it often underperforms the indexes. So even if it is tracking that index, because of the MER, it might be just 1 or 2% right below it. And last but not least is the passive version of the mutual fund, meaning it follows an index. So it's still a mutual fund. The MERs are lower, so there's kind of somewhere between an actively managed mutual fund and the ETFs. There's no human making decisions. You're still getting the diversification, but there's no commissions to buy and sell. So what I've done is if I'm making monthly purchases, if I can't find ETFs to buy commission free, because the monthly purchases are a couple $100, right? So if I can't find an ETF to make the purchases, I'm going to use a passive mutual fund because there's no commissions. Like I don't want to pay a 10% commission every month to buy a couple $100 worth of investments. So I'm gonna stop there. That was a bit of information. If you're already in investing, you've probably been exposed to a lot of these. Any questions before I go on? Everything sort of makes sense?
I have a question, if that's okay, Alash.
Sure.
How is the MER determined? Like how, for any particular fund, how is the percentage rate determined?
So kind of my observation is the closer to home, the lower the MER. Bond mutual funds also have a lower MER than stock mutual funds. But basically, the more difficult the research is in order to buy the investments that compose that mutual fund, the higher the MER is going to be. So, I might expect Canadian stock mutual fund to maybe have a MER between 1% and 1.5%. If the mutual fund contains small companies all over the world, then the MER would quite reasonably be 2.5%, 3%, because the research has to be done in person. Somebody has to get on a plane and fly. So that was kind of my take on it.
Thank you.
Sure. Yeah. Good question. All right. I just let 3 more people in for the next meeting. I'm gonna not have a waiting room. So folks, thank you for joining us. I actually don't know who it was that joined now. So we've sort of gone over some of the word definitions, and we've gone over some of the vehicles that are available for us to invest in. Okay. So stocks, mutual funds, ETFs are kind of the three. I have to confess, I'm not really a bond person. I have some mutual funds that have bonds, but I don't actually do individual bonds, but I do individual stocks. So I'm not going to be able to go much further into bonds myself. But if you have specific questions, we can I can maybe do some research. So next is risk. Now, throughout this presentation, I'm going to try to kind of divide it a little bit in each section between, if it's pertinent, if it's important, between if you have a financial advisor and if you do not have a financial advisor and want to go on your own. And later we'll talk about down here about financial advisors themselves. So when we talk about risk, if you have a financial advisor, they should have helped you evaluate it. If you don't have a financial advisor, then you should be able to kind of evaluate it for yourself. So risk appetite is kind of your ability to handle volatility. Now, let me say about risk. I know it's a four-letter word. It's actually not a bad thing. It just means volatility, meaning up and down. Some people don't take well to it if their portfolio starts dropping. So then their risk appetite would be lower. Okay, but it's just your ability to handle volatility, and it's just up and down movement of the investment value. It's kind of composed of a couple of things. Number one is able to handle it psychologically. Are you going to be able to see a statement where you lost 15% from a month ago and say, okay, well, that's just what happens? Or will you not be able to sleep at night? If you can't sleep at night, you're probably in something that's more risky and volatile than what you're able to handle. The other way to think of it is also, are you able to handle it financially? So do you actually need the money? Are you selling the asset that just dropped because you need to eat? So both of these are something that determine your risk appetite. So for example, if you're 20, you don't likely need the money. If you're saving for retirement, you don't need the money for 40 years. But if you still freak out with the statement coming with a negative, then your risk on your portfolio is probably too high. You could have somebody who's able to handle it psychologically, but if they're retired and they need to buy groceries with the food, they need to be careful about the risk. So if you have a financial advisor, they'll do something called a KYC, whether verbally or they'll give you a quiz with 20 questions where they'll determine kind of your risk profile. Or as I said, if you're going by yourself, then you can do know yourself, and you should be able to kind of know what you're able to handle and whatnot. So your overall risk profile is determined by the risk appetite up here. The time frame when you need the money back is quite important. You'll want totally different investments if you need the money for a vacation that you want to take in a year versus if you're saving for retirement versus if you're saving for your kid's school in 15 years or something like that. So you do need to be aware of it, of the time frame. And then finally, the third component of what kind of risk your advisor should have you in or that you should be targeting is the return that you need. So for example, if you say, well, I have $1 million and I want it to grow to 1.1 million, and I have 10 years to do it, I'm like, put it in a term deposit. That if that's your goal, then put it in a term deposit and it's perfectly safe and it'll meet your goal. When I first started investing, I told my financial advisor, yeah, I just want to make as much money as possible. And that's not really helpful, because then he puts me into very risky investments, which, you know, I may not be ready for. So the risk, the time frame, and the needed return drives the portfolio that you choose. So here, random picture off the internet. Different portfolios will obviously have different volatility, different risk, but that risk also drives the return that you're expecting. So that's why I said if you don't need a big return, you can be in a lower portfolio. So I don't know if you guys can see this. So the yellow looks like it's fixed income bonds. So bonds tend to be, all other things equal, tend to be less volatile, but also lower return than stocks. And then as you kind of move out on the volatility spectrum or curve, as some people will put it, you're getting more into, see, blue is stocks, and then red will be your international stocks. So it has a high rate of return, but also a high amount of risk, because there'll be a lot of ups and downs. And I'll show you a very cool chart later. So stocks are generally more volatile than other assets. Closer to home, stocks are thought to be less volatile. I mean, there's places in the world where things can go wrong, where there's the rule of law still isn't quite there. You know, Russia every so often will nationalize all assets, and all investors just kind of, you're out of luck. So closer to home, you're kind of familiar with everything, and people feel better about it. So that would kind of make it, Canadian stocks are the safest, US stocks followed by international stocks, increasing in volatility. Larger companies and their stocks are less volatile than small company stocks. So big company, not that I'm advocating it, but like Manulife or Royal Bank, if they have a really bad day, they're going to lose 2 or 3%. If you have a small company, they're going to lose 50%. But the opposite is also true. If they have a really good day, the same is true going up. Just a thought, everybody minds risk on the way down, but they're okay with risk up. But it's the same, up and down is risk. Bonds are generally less volatile than stocks. So bonds, and if you remember the balanced portfolios or balanced funds, is if you have a bond component. Bonds don't generally have huge returns, but they also don't have, and that's why you have the fixed income here. But you guys can see my cursor, right? I hope. And so the bonds are kind of like the stabilizing force in a portfolio, but they're also a drag on the performance. Having said this, if you buy a bond of a small company in Venezuela versus a stock of Royal Bank, it's likely Royal Bank is going to be safer, even though it's a stock. But all other things being equal, bonds are less volatile. So basically, the more risk you're able and willing to accept, and able, so that's the financial, I don't have to sell what just dropped to eat. Willing, I'm not going to freak out. The more risk you're able and willing to accept, the more time you have and the more return you need, the more volatile your portfolio will be. So a counterpoint to that example of I have $1 million, I want 1.1. If somebody says I need to double my money overnight, then go to Vegas or buy a lottery ticket, because there's nothing, no investments that I'm aware of that will do that for you. So your risk is going to be very high, that you're going to come away with nothing. But if you need to double your money overnight, if there's a loan shark after you, then you have to accept that risk that you're going to get nothing. Okay. So a Paul Samuelson said, investing should be like watching paint dry and watching grass grow. If you want excitement, go to Las Vegas. So what I have been doing myself is I've set up a portfolio. I've stuck to it. I buy more every month on an automated basis, which we'll talk about in a sec. And I don't really do anything that I consider high risk. So that's been my approach, and that's kind of what you're going to see here. Okay, so risk and types of investments. So I might have covered some of this already. So equities in asset allocation rule of thumb. So there's a rule of thumb where it says your portfolio should have in equities 100% less your age. So if you're 40, then you should have 60% of your portfolio in equities and 40 in bonds. Other people advocate 120 less age. So it depends on what you believe or your financial advisor believes. Account for pensions as risk-free income. So I should preface this by, it depends on what kind of pension. If it's privately run, then there may be still some risk to it. But if you're aiming for the kind of return that you need, and you're making a calculation of this is where I need to be and this is the return I need, or this is the cash flow that I'm going to need in retirement, you may be able to subtract the pension out of the number that you need. So if you figured out you need $50,000 a year when you're retired, and CPP is going to give you 10,000, then maybe you only need 40,000. A product that's out there called target date funds. It asks you, when do you need the money, and it automatically makes adjustments internal to the fund. You don't have to do anything, where it lowers the volatility by switching stocks into bonds as you approach that target.
Is that the same as a life cycle fund?
Yes, I actually heard that term just today on YouTube. Exactly.
Okay.
Some people like them, some people don't. You don't have any control, but some people are okay with that, and they let them do that. They let the mutual fund manager do that. So you'll see, version 2040, 2041, 2042, and so on. So you would just kind of buy the one that you need. Keep in mind though, generally you don't need all the money all at the same time. If you retire at 65, the average Canadian age, I think, is around early 80s. I think 82 for men, 84 for women, the last I recall. But you're going to live past 65, you're going to live hopefully another 20 years. So don't make your target date fund on the year that you're 65, because you're going to hopefully need the money later as well, not all on that date. This is, I say, if you have significant equities, but this is a good personal finance thing anyway. Have an emergency fund. If something goes bad, the transmission drops out of your car and you need $5,000. If you have an emergency fund, that emergency becomes an inconvenience. I'm quoting Dave Ramsey here. But if you're investing and you're heavily into equities, have an emergency fund so you don't have to sell equities to live on after they went down. The emergency fund, typically 3 to 6 months of basic expenses, depending on the type of job you have, if you have a spouse that works and so on. So if you're a contractor like myself, you should be 6 months or more, because there's little job security. You know, if you work for the government, maybe you need a couple of months worth, and that's basically it. This is different, having cash to buy more equities when they went down. Don't use your emergency funds to buy equities, because if the stock market just crashed, there's probably a reason for that. And if the economy's doing poorly and you're laid off and you're like, oh man, I got some sweet deals on you know, some stocks or mutual funds that went down, but then you get laid off and now you don't have anything to live on. Have two separate buckets for both of these. Okay. Perfect. Any questions? Anything else? So far, the two questions have been very good. So yeah, just interrupt me then. This is something you see on Morningstar. Something called a bucket portfolio. Now it's for the retired people, but it's kind of it's to get you thinking about how volatility and emergency funds work. So you basically have, and the goal here is, if your stocks, equities have dropped, I don't want to be selling them to live on. So if I'm retired, in bucket one, I have 2 years of living expenses in cash. Yeah, it's not making you much, but if the stock market has just taken a beating, you're able to live off of these 2 years worth of cash without selling any of the stocks. Second bucket is about 8 years of living expenses in fairly safe investments. So you got your high quality bonds and dividend stocks. And then bucket three is everything else in stocks. So this is going to be the engine of your portfolio after you retire. And if you're living for 30 more years, you don't want to be in cash, because inflation is going to eat away at the purchasing power. So you do need still to be in stocks. But at the same time, because now you are living off your portfolio, you want to make sure you don't have to sell these stocks after a crash. So there's different ways of running this portfolio once you get it set up and you actually retire and you're up and running. You could do things manually and then make a decision. So if stocks had crashed, I'm living off of this first. After 2 years are gone, I'm going to start selling some of these and I'm going to start cycling them into here. If stocks have done well, I leave bucket 1 and 2 alone and I live off of, and I sell some of the stocks, for example. So this is a fairly hands-on, but I just want you to understand how volatility works, and how you can prepare your portfolio and your finances in order to protect yourself and also to take advantage of crashes, for example. Because what a brave person can do is, if the stocks have crashed, they can start cycling money out of bucket 2 into bucket 3 to take advantage of the crash. Okay. So the advantages I mentioned: it avoids inflation risk in retirement by having stocks to get the high returns, and it avoids having to sell equities after they went down by having the cash and bonds. Okay, so bucket portfolio is kind of a cool strategy for retirees. Your financial advisor might be running something like that without really knowing it. These buckets, by the way, doesn't mean that bucket 1 is TFSA, bucket 2 is RSP or anything like that. You should have a mix anyways. Okay. Oh yeah, I love this chart. So I have a giant one, like 3 feet across on my wall in my office. I would put it into the living room, but I think people would talk. So I know you can't read it. It's an index chart. It's the latest one that I could find. It's kind of cool. It shows you what the exchange rate with the US was, what our interest rates were. That's all. Who was president and who was prime minister. But what I want to show here is, so I don't know if you'll be able to see this. So at the top here, we have a 14% annual return for this blue line. This is 1950, by the way, and the right-hand side is 2017. So this covers 67 years. And you can see, and this is the point of the risk versus return, that as you kind of move down here, you get some smoother curves, but the returns are lower. So the one down here is basically so just interest. You could call it term deposits if you want, and that's made about it's made about 5% a year versus 14, right? So if you do have 60 years, which I don't think any of us really do, but if you do, investing in small US companies is what gets you the greatest return. But oh my gosh, you've had some stretches. This is, I think, 68 to 73, where the market hasn't really done very well. But if you stuck to your guns and you kept buying, and now it makes this return, you are going to be looking pretty good. If you don't like this volatility and you think you're on a roller coaster, you need to get into lower, or at least a part of your portfolio can be in a lower volatility. I know everybody says, well, this is a no-brainer. I can see it going up. But remember the date range, and it's not pleasant to be for years. Like I know we just had a big drop, but it's recovered very quickly. And the reasons for that I'm not going to discuss, but like here you've had years where that really tests your conviction. So risk return 68 to 74. Term deposits are low risk, low reward. Small caps are volatile, but they outperform in the long run, at least historically. Any questions or any discussion on that? We're not great on time, but we're okay. Okay. So asset types. This is purely my opinion. There's lots of people who will disagree. To me, an investment is something that has a steady stream of income or a cash flow. So that would be real estate that has a positive cash flow every year, or something that pays dividends. This is my interpretation. Tons of people, what I call speculation, will also call investment. And that's basically an asset that goes up in price because somebody else is placing a higher value on it. So that would be stocks with no dividends, but they're making a profit, and their prices are going up. It could also be real estate with no positive cash flow, but the value of the real estate itself is going up. So you're depending on others, I guess, to bid up the price. Bitcoin and gold are also examples, but those are, yeah. So yeah, the value of the asset is determined by what somebody is willing to pay for it, which you could say is true for everything. And then finally, gambling, an asset that on an average isn't actually expected to go up. It's expected to go down on the average. It may go up. And so I kind of classify that as companies that don't make a profit, and maybe they're not getting any price appreciation. So these are my definitions. Please don't send me nasty messages where you disagree. It's my opinion. Okay, so for those who are young and on the fence about investing, so this is just compound interest. These are just calculator calculations. This is just math. If you invest a dollar for 40 years at 7%, it turns into almost 15 bucks. But if you invest it at 30%, it turns into half of that. So the earlier you start, you let the compounding do its work. Importance of low fees, pretty much the same calculation. If you invest $1 and it returns you 5% because you had a 2% MER, then you still get that halving of the returns. You'd think it would be proportional, but because of the way compound interest work, the curves kind of, they don't run in parallel. Now, just a note though, if you do any research and you look at a prospectus, you look online, the performance that it shows you on mutual funds and ETFs is always after the fees and the MER. So what you should be looking for would be mutual funds that have great performance rather than just looking for low MER. The low MER is important, but you want to make sure that the mutual funds are performing well, and whatever you see on the prospectus is after the MER. So this is just proving the point that markets go up in the long run. So the S&P 500, so this is the New York Stock Exchange, the returns for the last 31 years, you've had 3 years of negative 0 to negative 10%, but you've had 6 years of 0 to 10%. 11 to 20, negative 1, one year that's been negative, and then 8 years that have been positive. Negative 21 to negative 30, only 1 year, 6 years of positive. So over 92 years, even more. So there's always more green than red. Another thing, just looking at it graphically for those of you who are graphical. Same thing here. This is bear and bull markets in the US. Way more blue going up in bull markets than red. You see the 1930s in the Depression here. We had one in 2008. We had the dot-com crash in 2002. There's going to be another one here, I think, for 2020. Yeah. So overall, the markets go up. It's just that there's volatility. Okay. Investing strategies. This is kind of the last topic that I want to cover today. It turns out it's about halfway through. So lump sum, very simple. You have X dollars, $10,000. You buy the asset single time for, and usually you want to do a larger amount of money. And so you've done your research, you invest, and then your advisor or yourself, you watch it. Dollar cost averaging is kind of a two-parter. It's the most common way that people invest. Generally, they buy monthly, possibly quarterly. So you set something up, pre-authorized payment. If $500 comes out of your paycheck on the first of every, or out of your checking account on the first of every month, and it buys mutual fund A for $200, mutual fund B for $300, and you just let it go. So it's the same amount of money every time. So it does have a plus that if the market goes down, you're buying more shares because the shares are cheaper with that same $200 or $300 in my example. Obviously, if the market went down and you already have a significant portfolio, your whole portfolio drops. But during the time that it's down, you're buying more shares, you're buying cheaper. And when the market recovers, and as we've seen historically, it always does eventually, then your portfolio, your existing portfolio is back to the way it was, and the stuff that you bought during the downturn is now great. It's just adding extra power. So it protects against bear markets, and it's typically used with a pre-authorized payment, so the money's withdrawn automatically. If you're the type of person who likes to spend every last dollar in your checking account and you spend while there's money there, this is a great vehicle for you, great strategy for you, because you set this up, money comes out, you don't generally even miss it. You just spend a little bit less and you're saving for your future. It's, by the way, experts generally recommend saving 10, 15, maybe 20% of your gross income for your retirement. It depends on what you want. If you want a gold-plated retirement, you should be saving more, maybe 20, 25. If you want an early retirement, you should definitely be saving more. But my point to the spenders is, if you say, okay, I'm making this much money, I'm just going to set up 15% of my gross income to automatically leave the account and buy mutual funds for me, great. And then you can spend the rest. So this is the whole pay yourself first, and it's also automation. There's books called Automatic Millionaire that advocates this. Once this gets set up, people are also less likely to cut it off. But if you were to trust yourself to buy something every month, that might be tough because there's always better things to buy. I guess it depends on who you are. Now, second part of dollar cost averaging, however, is rebalancing. And I have to admit, I had financial advisors for years. I do not recall ever a financial advisor rebalancing my portfolio for me. Rebalancing, it actually adds significantly to the performance. And so what it does is every 6 to 12 months, you don't really want to do it on a monthly basis. Or if the portfolio has moved away from what you wanted. So let's say you did your risk analysis and you said, I feel comfortable with a portfolio that's 60% stocks or stock mutual funds or stock ETFs and 40% bond mutual funds. So you set that up, and let's say you're doing $1,000 a month, so you're putting 600 into the stock mutual funds, and you're putting 400 into the bonds. And then at the end of the year, if everything stayed exactly the same, you would still be 60-40. But these different assets move differently, and so so what you want to do is you want to get back to the proportions and to the risk profile, especially that you had. So let's say on a given year the stocks go up more than the bonds. So now your portfolio is 70% stocks, 30% bonds. So you would want to sell the bonds, and sorry, other way around. You want to sell the stocks and you would buy the bonds. Think of it as making money in the risk in the risky assets, taking some money off the table, putting it in a piggy bank. Next year, stocks perform really well again. You take some money off the table, put it in a piggy bank into the bonds. One day, you're going to find yourself in a stock market correction where the stocks have crashed. That's when you crack open the piggy bank, you rebalance, and you sell the bonds and you buy the stocks. But when you're 70-30, you're more exposed than you want to be according to your risk profile. So to be back in your comfort zone, that's why you want to sell the stocks and buy the bonds. It also, as far as your portfolio is concerned, you're selling high and buying low. Keep in mind, this is about proportions, 60-40 in my example. Both could have gone up, but disproportionately. Both could have gone down, but disproportionately. or one could have gone up, the other one could have gone down. It's about proportions. Okay. Now, just kind of a tax tip here. Depending on the account type that we're talking about, if you're selling something, you may have to pay taxes on any capital gains from that sale. So what you might want to do is you could rebalance by buying more of whatever is now on the low side rather than selling. So that way you avoid possibly commissions and or the capital gains tax. Okay. Now, if this isn't really a strategy, but I sort of included this in here. Personal oversight is when you're taking, and this is the last topic, and sorry I've gone over a little bit. Is if you're keeping an eye out on your investments by yourself or with the help of an advisor, and this is kind of doing the right thing. Okay, so Mr. Warren Buffett, I'm sure a few people have heard of him. Be fearful when others are greedy, and greedy when others are fearful. So the time to buy is when the prices are low. I know it's really easy to buy when the prices have been going up for a long time, but the chances of a correction and a drop are higher the longer it's been going. It does take guts or intestinal fortitude, as some wrestling announcer used to say, to buy when people are afraid and are selling, but that's when the money's made. So you should actually be selling when the stocks are expensive, and most of the people are greedy. So the market's been going up, they're like, I got to get into this, and they keep buying, and the market just keeps going up, and it has a tendency maybe to go beyond where it should be, because people are, the whole FOMO, fear of missing out. So that's when you should actually be selling into that demand. You should be buying when things are cheap, when people are panic selling and think the world is ending. Speaking of which, there's a phrase, you should be, if you think the world is ending, you should be buying ammunition and canned goods. Otherwise, you should be buying stocks. Just a phrase. So if you're doing personal oversight, you're making your own choices to outperform the markets and all of the experts. We all try it. I'm trying it now, to some limited success, let's just say. But it's your choice. I wouldn't start out investing with personal oversight. As I said previously, I started out with mutual funds. Might be something to do. If you are investing by yourself, have an investing thesis and compare your portfolio to this thesis. So previously I said I liked emerging markets. The people being pulled out of poverty and wanting to drive a BMW, have an iPhone, and drink a Coke. That's my thesis. Come up with your own, and then compare your portfolio to this thesis. And yes.
What about cruise lines?
What?
I mean, cruise line is very cheap right now. Cruise lines.
Oh, cruise lines.
Yes. Is it too? It's considered like it is bought on the street, but then it's also not safe.
Is that your hot stock tip?
No, I wanted to buy it. Kept going up, but it's still cheap compared to the high. But it's been trending up. But by the time it's safe to go out, I'm sure it's still going to be at a high. Too late to buy at that time.
It's it's something you can try. I personally don't have any cruise lines or airlines.
Okay, you're the banks. Okay.
Yeah, it's everybody has their own thing. So
Okay.
so sorry.
Nothing.
Okay. So the problem is with hot stock tips is that If somebody's telling you about something that just made 200% for them, it's likely that you know, most of the going up has already happened. So if you buy into it after somebody at the water cooler told you, yeah, it could keep going up, but if it's been going up for a while, I wouldn't. Okay, and when markets go down, well, what can you do? There's three things, you have three choices. You could sell, which is generally the worst thing to do, because by the time you sell, the market's already dropped, especially if you're reacting to a mailed or even an online statement, which is usually 2 months after the fact of, you know, like second week of the following month is when you get the statement. So you're probably selling near the bottom, or at least you've missed a big drop. It would also throw your portfolio into disarray. So, like me, I'm not going to liquidate my whole portfolio like on a hunch or just because it went down 10%. You could do nothing, and that's generally what financial advisors suggest. Or you could buy more. So when prices are low, and they will go back up, like I said, unless you're buying ammo and canned goods, the stocks are on sale, so generally buying more is the way to go. Easy to say, hard to do. Easy to say, hard to do. It does take a bit of heart to do that. We're 10 minutes over. Apologies. I'm going to stop here. This is actually a good natural stopping point. And I want you guys awake when we talk about taxes and RSPs and TFSAs for next time. Let me open it up for questions. Anything? I know I went through it fairly quickly. I hope it was comprehensible. I hope you guys got value. I hope you come back on Thursday where we'll do the rest. I'm trying to.
So I have. Sorry to interrupt. I just have a question. Are you going to go over how to analyze a stock or something in the next one, or?
So in the next one, I'll talk about analyzing a mutual fund.
Okay.
Analyzing stocks, I do have a presentation on it,
Mm-hmm.
which I've given, and it seemed to work fairly well. Buying individual stocks is a little bit more advanced.
Mm-hmm.
If you're interested, and if a few more people are, I've got the meetup for a month, so I've got it until early July. So I'd be more than happy to do how to analyze stocks. Keep in mind that is very personal. Everybody has their own formulas, their own things they look at. But I would be happy. Why don't you message me in however you learned of the meetup, and
Oh, I can't. Okay, sure.
Yeah.
Yeah, I got to know through your friend Satya.
Oh, okay, cool. Okay.
Yeah.
So yeah, we'll touch base, and I'd be happy to take you through stock analysis.
Sure. Thank you.
Sure. Anybody else? I see a few people unmuted themselves.
I have a question, Alesh.
Okay.
Hey, so you mentioned something about like offsetting taxes if you want to buy, like if you've made a lot of gains, you want to buy the smaller stocks. Can you kind of like clarify that?
Yeah, it wasn't exactly that. So for the rebalancing, if I have it in a non-registered account, meaning if I sell something that went up, I am going to pay capital gains taxes on it. And maybe I don't want to at that particular time. So remember, we want to be 60-40 in my example. It happened to be 70-30 at the end of the year. So in a non-registered account, instead of selling 10% to bring the stocks from 70 back to 60, and then paying capital gains on that 10%. What you might want to do is just throw extra money in and just buy the bonds to bring it up from 30 up to 40 without selling anything.
Mhm.
So by not selling anything, you're not having to pay any taxes.
Okay.
This strategy only applies to non-registered TFSA and RRSP as long as the money stays within the RRSP portfolio or the TFSA portfolio. You can do all sorts of selling and buying, and you don't have to pay any taxes on it until you, well, for the RRSP until you withdraw it. With the TFSA, obviously, it's tax-free.
Gotcha. Thank you.
Yeah, you with me?
Yeah.
Perfect. Okay. Great questions. Anything else?
What's the small grant? Is that like for individuals to do nonprofit work or for small businesses?
Yeah, I would ask you to neighborhood small grants, go to their websites. You do an application for a project. It looked like it could be anything from cleaning up a park through to something like this. And you kind of enumerate your expenses, and there's a committee that will give you a check if they deem you worthy. So great foundation. I mean, they covered the fees for the Zoom and for the meetup.
Yeah, I interviewed for a job there, but it's not
Oh.
high paying though. It's an investment management job for managing foundations, $1 billion. Actually, it's not that high paying. I'm surprised because the money goes to the grants, baby. So the
Yeah,
internal management staff don't get paid that much
yeah.
compared to like financial services.
Well, working for nonprofit is a acquired taste. All right. Any other questions about the presentation? I don't want everybody talking at the same time, but was there value here? Would you prefer me to cover something else, something in more detail next time? This is for you guys, so whatever helps. Everybody found it useful, and we'll be back on Thursday.
Yes. Do you do the dollar cost averaging every month, or you also do the lump sum?
So for me personally, I put money into my corporate trading account on a monthly basis into 4 mutual funds. I max out my TFSA on a monthly basis for that month, obviously, with index funds. And then any money that I have left over, I will throw into individual stocks as they catch my eye.
Hey, LS, just a quick question, just because you kind of talked about this topic, and obviously these are your thoughts here, and I was just doing recent research, but what are your thoughts on the different vehicles, TFSA, RSP, and just an open account? What level of volatility would you weigh heavier? I've heard some mixed opinions about which ones you should target for a portfolio for higher gains, like let's say TFSA, because it's like post-tax already. Versus increasing your RSP, but you still need to take it out in the future to a certain amount.
Yeah, interesting point. So I do have a section about this where I kind of compare and contrast. One thing for sure is put any bonds that not that you need to have bonds. But if you have bonds, make sure that they're in an RSP or TFSA, because bonds pay interest, and interest gets taxed the heaviest out of anything.
Mm-hmm.
So those you would want to have in a registered account. I kind of general rule use non-registered if the TFSA is exhausted or if you're expecting losses. Non-registered is the only one that can use capital losses to offset capital gains.
Mm-hmm.
If you lose money in a TFSA or an RRSP, nobody will give you anything. With the non-registered, you can at least use them.
Mm.
TFSA will always beat non-registered. Like if I don't, like I said, I'm not really a bond guy, so I have mutual funds that have stocks in them in the TFSA. My RRSP, pretty much the same thing. Difference between RSP and TFSA largely depends on the tax bracket that you're in when you're buying and selling them.
Oh, sorry. And a quick question just before I lose that thought. For non-registered on the capital loss, you can only offset it to capital gains, right? It's not based on income. If I tried to research this myself and I couldn't find a good understanding of it. Maybe does it go against your personal income or just capital gains? Just capital gains, right?
Only capital gains. This is an accountant question, but I'll give it a try. If you have capital losses, I believe you can go back 3 years to offset any capital gains, and you can carry capital losses forward as far as you want until you get capital gains, and then you can offset them. But you're exactly right. Capital losses only offset capital gains, not your personal income. They're not. It's not a tax write-off.
Okay, thanks for the confirmation of that. I think that's what I read. Thank you, LS.
Yeah, so we'll get into taxes. The tax table. That's why I said I want you guys awake. So I'll do that at the beginning of the next session. Okay. So yeah, we kind of finished up when markets go down. So great question. Questions. I hope everybody had good value out of this. We went a little bit over time, but hopefully it was useful. So Thursday is the next one, and then just kind of a general question one will be on Monday. Again, not financial advice. This is just opinion. Please don't sue me. If there's no other questions, I shall bid you a good night, and hopefully see you all guys on Thursday. All right.
Yeah, thank you for the presentation.
All right.
Very good.
Thank you guys. Bye.
Thank you. Thank
Bye-bye.
you.
Thanks,
Very
Flash.
much.
Everyone.